Everything has changed in 2022. There's a war going on between Russia and Ukraine, gas prices rising exponentially, we have inflation increasing on a monthly basis, and honestly, it doesn't seem like any of this is going to change anytime soon. So for the average Joe investor, what does this mean? Especially if they're currently investing in income ETFs like QYLD, RYLD, NUSI, you know the list. Well, in this video, we're going to go over 3 popular investing strategies for QYLD or any other income ETF. And we're going to discuss if they are still viable strategies in 2022 in something like a bear market, which is what we're almost in. The 3 specific strategies we're going to discuss are going to be the following. We're going to talk about potentially buying a car with QYLD dividends and then making your monthly payments with the dividends. We're going to talk about investing in QYLD on margin. This is super popular amongst Reddit and something that I've done myself in the past. And then last but not least, we're going to talk about, are these funds still good for people that are retired? Now, in order to determine if these are still good strategies, we're going to have to use some spreadsheets. We're going to use some data. We're going to go off history. But just remember, past results don't guarantee future results. However, they can help us forecast out what might happen in the future. Now, if you're new to the channel, welcome. My name is Matthew Muniz. I do weekly videos on anything personal finance or fitness related. If you work hard for your money and you want it to go further, then go ahead and smash the like button down below, subscribe to the channel for weekly content. And last but not least, quick note, I am not a financial advisor. This video is not financial advice. These are just my opinions. It's up to you guys to do your own research and make your decisions based on what's best for you and your family. And in this video, I'm not going to explain what QYLD or RYLD or any other covered call ETF actually is or how they work. This video is if you already have a basic understanding of these ETFs. This is more of an analytical approach to investing. So the first strategy that we're going to discuss will be using QYLD to pay for a car, or basically using the monthly dividends or distributions from your QYLD investment to pay for pretty much anything. Some people use it to invest in growth or, pay for their mortgage. But I like the car example. It's easy to look at and it applies to people, especially myself, because my family actually does this. The great thing about the car example is everyone loves when they pay off their car. You work hard every single day and your monthly income then goes to pay for your car insurance, that kind of stuff. But when you pay it off, it's awesome. Well, if you have enough money to pay cash for a car, and yes, I know not everyone's in that situation, but just as an example, you have the option of paying for the car, or you could put your money in something like QYLD and then use those monthly distributions to pay for your car being financed. At the end of the day, your QYLD investment paid for the entire car, and theoretically, you should still have all that money that you were going to use to pay for the car. It almost seems like a win-win. But with every strategy, there's always risk versus reward. So let's talk about that. So what is the reward? Well, like I just said, you gain a car and you don't lose any of your initial investment. You're basically not paying any cash for the car. In a sense, it's all passive income. But what is the risk? Well, to be honest, there's really not that much risk. The risks is if QYLD's price goes down. Now, over the past few months, it's gone down quite dramatically. And yes, we are losing money, and I'm sure many other people are losing money. However, if we go off precedent, historically, the price of QYLD does fluctuate. It goes down, and it goes up, and it goes down. And yes, over time, it does trend downward. However, we are using it in this specific scenario to generate the monthly income to then pay for what we wish to pay for. So let's just look at an example. We're going to look at a spreadsheet where we talk about a couple different car options and how this would work. So right here we have a little spreadsheet that shows the dividends for the previous year. It shows the share price and how it's gone up or down, which it has gone down like I mentioned. And then we're going to look at some ideas for car payments. So basically we found that the average dividend per share was 23 cents. Now, I want to make a conservative estimate, and we're going to call that the conservative dividend per share. So for every share, you're going to get 20 cents. The reason I lowered it is because if we go off of QYLD's history, it usually fluctuates between 19 and 21 cents for the past few years, and I don't really see it changing by much. Now, what we're going to look at is we have 2 car options. We have a car that costs us $30,000 and then one that costs us $50,000. If we were to finance it at 3.5%, our payments would be as seen below, $545 or $900. So how many shares of QYLD do you need to generate enough monthly income to pay for that? Well, you need 2,725 or you need 4,545. The way we determine these is we take the total loan payment per month and we divide it by the conservative dividend per share. So how many shares at 20 cents per share do we need to get to that payment? Well, right here, as you can see. So the initial investment you would need to do would be a $55,000 investment or a $90,000 investment. So yes, you need to have more money to do this, but if you're in a decent financial situation, and I know this isn't everybody, This is just an idea. This is just one strategy that people use. This is something that my parents do. One thing to factor in though is that this does not take into account taxes. I did not include taxes because everyone's tax situation is different. So in general, when we look at QYLD to generate monthly income and pay for something like a car, in reality, that's exactly what QYLD was made for. That is the objective of QYLD. We aren't looking to grow our portfolio. We are just looking for monthly cash, and that fits our needs. So the risk of the asset price going down, not really a concern because we don't care about that. We just want the monthly payments. And one last thing I want to mention is just because you don't have the money to pay for a car up front today doesn't mean that you can't delay gratification. So if you have another form of transportation, you can continuously set aside money to then later use to do something like the technique we just talked about. So just because today you don't have enough money to do this doesn't mean you can't start saving today and set yourself up for success in the future. So sometimes you don't need to buy the brand new car today. You don't need to buy the brand new Audi today. You could buy a used Toyota Camry, which might last you forever. Just an idea. So strategy one, still a great strategy. Then the next strategy we're going to talk about can be pretty controversial, but the math doesn't lie. Investing in a covered call ETF such as QYLD on margin. Now, if you're not familiar with margin, I'm not going to explain it in this video. I have a video linked below that I made a few months ago that explains exactly how margin works. So go watch that if you don't understand. But basically, margin is when you borrow money from your brokerage, somewhat like a loan, but not exactly, and you use that to invest in assets or securities. So why would we want to invest in something like QYLD or RYLD? Well, theoretically, you can make money out of thin air. You're using the brokerage's money that you borrowed to generate your own profits, which you can then use for whatever you like. But as with all investing strategies, we have to balance our risk versus our reward. So the reward is infinite cash flow, infinite money glitch. The more you borrow, the more monthly payments you're going to get. You're still going to have to pay for that money, but the profit typically will overcome it. However, this is where the risk is a lot more concerning. So there's a couple different types of risk when it comes to a decision like this. The first one is being margin called. Now you can minimize this risk by making sure that you don't borrow all the margin that you possibly can. So if you have a portfolio worth $10,000, you don't want to borrow $10,000 in margin because then there's going to be a higher chance that you get a margin call, which means that they will then liquidate your assets to pay off your debt. You don't want that. So in order to minimize that, you can borrow less. Instead of borrowing 100%, borrow 25%. If you have a $100,000 portfolio, borrow $25,000. And your chance of getting a margin call is significantly reduced even in a bear market. Remember, as your portfolio value drops down, you get closer and closer to your margin maintenance number. You don't want that. Now the next risk kind of goes hand in hand with this, but it's the asset price dropping. So over the past few months, the asset has dropped over 10%. If you have that drop in price and you had borrowed 100%, there's a good chance you could have been margin called. So the concern is if the price keeps dropping, then we're going to keep getting closer and closer to that. So even though you may have been strategic in how much you borrowed, you still have to worry about QYLD's price dropping. But if we go off history, which doesn't guarantee the future, but can help us give an idea, we do see that the price drops and then it goes back up and then it drops and it goes back up. So if you're holding long term and you're not being too aggressive on how much money you're borrowing, then this is yet another risk that we can try to mitigate. Now, the third risk though is with the Fed's rising rate. So there is a pretty popular thought amongst investors right now that on March 16th of 2022, they're going to raise the rates for borrowing money, the federal rate, by 25 basis points. This means 0.25%. There's also a belief that there's going to be 7 more rate hikes for the rest of this year, and they could continue next year. Part of this is to battle inflation. So why is this important? Well, margin rates are typically tied to the rate to borrow money. So if the Feds raise their rates, then more than likely your brokerage, Robinhood or TD Ameritrade, M1, whatever, they're going to raise your margin rate. The higher your margin rate goes, the more it's going to take out of your profits. A good example of this is on March 23rd, Robinhood's interest rate is going to go from 2.5% to 3% because of these rising rates. So you're going to be losing a whole 0.5% of profit. Now 0.5% may not sound like much, but over time, and as you invest more and more and more money, that's a huge amount. And this is just the beginning. It's going to go higher and higher. At least that's what we think will happen. So let's look at an example. So right here, I have a spreadsheet that we have determined we're going to borrow $25,000. And we're also going to use that Robinhood interest rate of 3%. So we invest $25,000 that we borrowed, and remember, we don't want to borrow all the money we can. So theoretically, if you're borrowing this much, you should have $50,000 or $100,000 invested. You could just lower this money to $5,000 if you're new to investing. Maybe you only have $10,000. It's fine, doesn't matter. But just for easy math, we'll do $25,000. The rate, 3%. How many shares did we get? Well, if we invested on January 1st, 2021, when the cost of QYLD was $22.83, we would have been able to pick up 1,095 shares. Now the margin percent, this is the rate for the margin divided by 12. It's going to be 0.0025. That's a monthly rate. Then we have our margin cost. So every single month, this is how much we have to pay. And what we do here to get this is we take the amount borrowed, which is the $25,000, we minus $1,000, and the reason for that is because your first $1,000 with Robinhood is free margin, and then we add in $5. The reason for that is because Robinhood charges $5 a month to do this. So really, you don't get $1,000 for free, it costs $5. But here we see that our cost per month for borrowing this money is going to be $65. So if our dividend was 22.9 cents on 1,095 shares, we would have a dividend of $250. Well, we owe $65. So our actual profit after paying back our margin, we made $185 out of thin air, hence the infinite money glitch. And this continues on, 180, 140, 150, 480. That was a huge dividend that was announced at the end of 2021. Don't expect that to happen again. But let's just go down here and take a look at some stuff. So our total margin payments was $910 that we paid to borrow that money. Our total profit was $2,655. However, you cannot forget taxes. Now, I did taxes. I took the total profit and I multiplied it by 24% for me. The reason I did that is because that is my personal tax rate, and it varies depending on how much money you make. So just for the example, I would owe $637 in taxes because of this profit. So my actual profit after tax was still $2,000. That's great. That's awesome. However, what if the margin rate goes up to 6%? If we change that, we now have to pay $125 a month, and our profits are significantly reduced. Now you see, we only made $1,379. Now, if the margin rate continues to go up and we get to, let's say, 10%, at that point, I'm pretty sure nobody's going to be borrowing money. You're still profitable, but you have a lot less profit to cover, for instance, drops in price, drops in dividend. There's a lot of things that could be involved with that. So you just need to be conscientious of the fact that the dividend is not guaranteed. Now, we know that we're going to be taxed. There are some ways to counter this, and I'm not going to go too in depth, but I will tell you that margin interest can be written off. However, only if you don't claim the standard deductible on your taxes. And it's also pretty complex, so I recommend if you're going to be borrowing money and wondering about taxes, you should probably reach out to an accountant to get a better feel for what you're going to be doing. So when borrowing on margin, you have to remember that the margin rate can change, which will lower your profits if it goes up, which we expect in the future. And you have to remember the taxes. At the end of the day, you're still making profit. So yes, it is still a viable strategy. However, you just have to be aware of the risk that you're taking on. I think anything over 4 or 5% for me, I wouldn't even consider borrowing, but that's just my personal opinion. You can still make money, it just, I don't know, I just don't want to borrow money. Now the third strategy, and this one is probably the best strategy and the most useful when it comes to using covered call ETFs, is in retirement. So 100% without a doubt, investing in something like QYLD is a good strategy if you are already retired or if you've quit your job and have achieved financial freedom. The thing you have to keep in mind is that your monthly expenses need to be significantly below your monthly distributions from whatever covered call ETF you've invested in. Now, a really good idea, and a lot of people recommend this, is to diversify your portfolio with something like the quadfecta. So the typical quadfecta is going to be your QYLD, your NUSI, DIVO, and JEPI. The reason you have all 4 of those funds is they all have high monthly distributions, and they each kind of check a different box when it comes to their objective and why they should fit in your portfolio. So when you diversify your portfolio, you're minimizing your risk and still allowing for excellent returns. Obviously, the gain of investing in something like this in retirement, you're going to be making passive income to support your lifestyle. The risks involved are, well, if for some reason the distributions start to lower or the prices just continue to tank and go to zero, which I personally don't think will ever happen, I guess you could say that's a risk. The only other thing that you have to keep in mind is, yes, you still have to pay taxes, and with covered call ETFs, the taxes are typically not qualified dividends, even if you've been holding on to these for a long period of time. So they're going to be taxed higher. But if you're already retired, or if you've achieved financial independence at a very young age, good for you, you probably are in a lower tax bracket. So even if you may be paying ordinary income taxes, it's not going to be as high of a percent as if you were still working your 9 to 5 and, you know, paying your mortgage on your house and supporting your family, stuff like that. So more than likely, the taxes won't be that big of a hit. So all in all, for retirement, these funds are awesome. Now, I don't think you should put 100% of your portfolio into them because I think you should still look into other options, but a significant proportion of your portfolio going into them is, I would consider, a good idea. Last but not least, hopefully if you are retired, you've taken advantage of some tax advantage accounts like an HSA or a Roth IRA, because if you have these funds in those retirement accounts, then you don't have to worry about taxes at all. So you're pretty much set. So all in all, I've discussed 3 strategies that a lot of people use and a lot of people talk about. And in 2022, even with the current market, I think that they're still all pretty good options. I think the most risky is definitely the margin one. However, these funds are some of the most popular investments right now, and for good reason. You cannot overlook the fact that there is a psychological aspect of investing, and when you're seeing yourself receive monthly income, even in down markets, it helps you stay positive and it helps you manage your funds a little bit easier. Now, even though past results don't guarantee future results, I think if we go off precedent, we can expect that prices will continue to fluctuate, dividends will continue to stay strong, and if you're invested in these, you're probably looking at some good returns in the future. With that said, leave me a comment down below with what you think of these strategies. Maybe you have a different strategy. I'd love to hear it. I respond to all comments, or at least I try to, and I hope to see you guys in the next video. Take care.